In Chapter 5, we're going to talk about anticipating red to green moves. It's one of my most favorite types of long plays. These are off charts that have been in play over prior days. We'll take a look at what types you should be focused on and what to expect as the trade pans out. There's also times that stocks need to pull back. They need to consolidate before heading higher after a big move. This is very normal, and we're going to go over how to be able to take advantage of that. They let some of the profit takers out in the morning, they consolidate it, and many times they end up perking back, which you're able to couple it with the ABCD type pattern, red to green, and end up getting a very profitable trade. Additionally, there are times that you might just have to put trust in the daily chart and trust what it's telling you to make an informed entry. And even though the risk is elevated, because it's not a typical entry where you have X risk and X reward, but rather you're actually anticipating it on a fast drop in the morning because it might have some profit takers and market sells, but at the end of the day it has a solid chart and there's a very good chance that it's going to continue on its breakout. And that is what we aim to take advantage of. And last but not least, as you guys all know by now, it's not good to chase a stock, but you need to know when it's actually okay to chase. Because there are going to be times where a stock pops up and you're not going to have that dead bottom print and you're not going to have that solid risk versus reward, but you can actually play a little bit smaller, size in accordingly to what you're doing, and then go ahead and chase the trade. But I'm only going to do that on certain chart setups, and I'll cover those. So once again, here's the list of the different textbook longs that I like to take. And we just went over gearing and perking in the last chapter, but now we're going to focus on anticipating red to green and what a weak open, stabilize, and perk looks like and when to anticipate this type of trade. Anticipating red to green. This is one of my most favorite trades because they give the best action. They move the most, and by the time people get them on their radars, we're already locking in profits. A stock must be in play prior days. This means that it has to be up large the days leading up to it, or even down large. But the point is it had a big day. Everybody is watching it. It's pulled back. It's red. They're afraid to buy it. But as soon as it goes green, for some reason, everybody likes to buy. Once again, the key is it's on people's radars. It's been moving around like crazy in the recent days, and there's a big audience watching. It's also good to couple it with whole and half dollar marks because that's where a lot of the eyes are. The more the audience, the better. Let's take, for example, a stock that maybe ran $5 to $7 yesterday, and it closed at 7. And the next day it pulls back towards the 670 level, and it started to trend, started to grind and magnet around 670s, 680s, and then it starts to gear and perk like we just went over with the ABCD type pattern. So it starts to get a little bit tighter and tighter, and you can start to see it inch up towards 680, 685s, and all of a sudden the volume comes in, and you can start to anticipate that long because not only do you have the 7 break, you've got the gearing and perking that we just covered, but now throw in another event, it's going red to green on the day. And this combination of all these different events has the biggest audience, and it's going to have the biggest result. And it's always good to lock some into this. I always take off half right away just because if I get the trade right, I might as well lock in some, pay myself, and then let the rest ride and see what it can do. But typically when a stock crosses red to green on the day, it does have a surge and it does pop. Let's take a look at SPWR, and you can see how it's got this big pop, then it starts to pull back and starts to consolidate. And this white line here is the prior close, meaning it closed at approximately 11:05. So now you can start to see how it starts to grind up with the higher lows, just like we went over on the gearing and perking, and then it starts to break the prior top right around the 1090 level. So you can see here the top, the bottom, and it starts to gear with a higher low right here. And you can anticipate anywhere from here to here the breakout, and as soon as it breaks out, heads towards red to green, pulls back, red to green, and it takes off. Next is MEG, and this is a recent play that we just had, and it had a major breakout on 2 million shares. So this is on everybody's radar. It just went from $7 to $10 over 2 days, or 8 to 10 over 1 day. And then the next morning, it has a weak open. So it just slams right back down, pulls back, and you know that just yesterday this went from 8 to 10. So everybody's going to have an eye on it, and when it starts to rebound, they're going to want to be in. So it pulls back again, and you don't want to anticipate anything until, number one, it holds a double bottom, meaning it starts to base at the same level, or if it starts to grind up and holds a higher low like we've discussed. So you can see here there's three options. So now you've got this top at 920 level, 915, 920, and you've got this double bottom around 9. So at any point you can anticipate this prior top being broken with a risk on 9, or let's say you miss it. Pops, pulls back, pops again, pulls back, and you still know, hey, you know what, I want to be long because this thing just went to 10, it's only 930, and it's probably going to rebound. Well, where can you set your risk versus reward? What is the next setup that you can find? And as you can see, it starts to grind, same pattern that we're used to. It starts to get tighter and tighter and tighter with a top pretty much at 935. So you know that any volume with a 935 break is a good risk versus reward long with a risk towards the bottom here, towards 920s. And if you miss those 2 times and it breaks out again and you said, hey, you know what, it could go red to green. Well, here you have it again. It's got a top around 950s, 955, starts to grind back up, and now you can start to anticipate the red to green. And again, this is the prior close, and you can see as it gets closer and closer red to green, the volume starts to surge and it pops through, and then it starts to pull back. So this is why I always suggest locking a little bit in when you anticipate that red to green move, because everybody likes to buy when it goes green, but once it crosses over, then people start scratching their heads and say, okay, well now what? Next is NLST, and this is a pretty nice chart of a stock that had ran in the prior day. It ran up towards 350, and then it pulled back, and it faded in the morning. It didn't really have any follow-through momentum. But as you can see, it was a pretty much magnet around 250 all day, sideways, up, back down to 250, up a little bit, pulled back 255, up towards 260, and then it finally started to get a little bit of traction, and then you can see on red to green the volume came back in and it just took off. So you can see where it starts putting this top towards this 265s, and you can see how the higher low, higher low, higher low, higher low, it starts to get really tight like we've discussed, and then as soon as it breaks out, you can anticipate that red to green, and you've got all those chasers that want to be in just because it's green, and on top of that, you have the magnet on the whole number 3. Another look of a different chart, but you've got this week open, and this was a high flyer in the prior day, popped up, pulled back, rebounded a little bit, held again a higher low, started to consolidate. You can see that it put in a top right here, and as soon as it breaks that top, at 47, not only do you have the whole number break at 47 plus the red to green, but you have an educated risk. And you have an educated risk to this bottom here, 4660s. So if you can anticipate the whole number break of 47 anywhere before that and risk that 40 cents per share for a potential upside on a stock like this, which has $1 or $2 range, you might risk 50 cents for potential $2 move. So you can see here with the lines, you've got the top, starts to gear up, gets a little bit tighter, and again a higher low, and as soon as it breaks that, red to green, and it takes off and does not look back. Next, what I want to look at is weak opens, stabilizing, and perking. And this is usually on charts that are starting to reverse off the bottom. Charts that have normally been in a downtrend, but now they start to shift and the longer term trend becomes bullish. And what the point is to look for all weak opens and anticipate the red to green, because over the long term, it's going to be heading up as long as that trend reversal holds. And I'll show you a couple charts of exactly the wicks to look for on the candlesticks that symbolize something that's usually getting accumulated or bought up, and how to set your risk accordingly when that stock continues the trend reversal without breaking trend. And the key here is that it does not break trend. Let's take a look at FONR. And this is something that I want you to start to see in these next charts I'm going to be going over on the daily charts. And you can see that when it pops up, when it gaps up that next morning and it pulls back, it gets bought up. And then the next day it opens up, it pulls back, and it gets bought up and it closes higher. Again, it opens up, pulls back, and it closes higher. And this starts to show accumulation and the trend is holding. As long as that trend holds, I'm interested in buying all week opens, any red to green action. You can see the same idea here where TC, it had a short-term top here at 320, again 320, and then you can see it has a higher consolidation that we went over, but as soon as it started to break out through that 320, the dip started to get bought. Each morning, it might have had a little weak open, and then it closed towards the highs. Weak open, closed towards the highs. And the same thing, it continued to do it up towards 450s. This is actually the same stock a couple months later, and it had pulled back, and then it had a top at the 3, top of the 3, a top of the 3, and it started to consolidate, and it finally broke trend. But you can start to see the wicks were getting bought up, and bought up, and bought up since this first day. So it broke out towards 3, pulled back, got bought up, pulled back, bought up, pulled back, got bought up. In each week morning, each pullback ended up closing way off the highs. And that's the key that you want to focus on these trending charts. And as long as they hold trend, they continue to play it and risk on lower day. Here's another recent winner, NIHD. You can see that the top is coming in here at 5. With a line here, this will help you see it. But you've got a top at 5, and then it breaks towards it, tops out again, slams down. And then the next day, you can see the wick, week open, wick, week open. You can see the wick. Week open, you can see the wick, it closes higher, same thing. And it continues to do it all the way up towards 950. So although it's in hindsight, you can see here that buying the week open every single day would have paid you money. But the key here is that any of these days you could have longed it with a set risk. So when it starts to pull back and it starts to hold a higher low, just like we went over with the ABCD type pattern, you set your risk on low of days and you anticipate the red to green move. So let's take a look at what it looks like intraday. So that same stock, NIHD, that we were just talking about, now that it's in that bullish trend and it's got that trend reversal going on, we're interested in every week open anticipating the red to green. So as you can see, it's got that morning move, but it puts in a top, starts to consolidate, grind up, puts in another top, but a higher low, starts to grind up, and then it hits that red to green. So you can see here, if you're anticipating the red to green after you have a set risk, you can buy at any point in here, 670, 675, 680, and your risk is based on the 660s. So you're risking 10 to 20 cents a share for the potential breakout of not only 7, remember, whole numbers, but beyond that. And then later on, towards $8, this stock started to break out again, and yet again a week open, and you may not, again, have nailed this perfect entry down here at 780, 785, so what I want you to start to see here is, so it pops up, but it's holding trend, and it starts to grind up, grind up, grind up, and it ends up breaking this 810. You can see the top here, 810, 810, 810 again, but it starts to grind, and then it takes off from there, and it doesn't look back. But the most important part is that 810 break, you can take that long, all day long, with a risk at 8. Once again here, you can see A&R is another week open, starts to consolidate, starts to grind back up, and head red to green, and then you can anticipate that with a risk on the 810s, 812 range, which you can see here is the price towards that lower day. Keep in mind that these are all charts that have come off the lows, that have started a trend reversal, and they're starting to hold a grind up with each week open getting bought up. And I'm trying to show you as many charts that I can because each one looks a little bit different, but at the end of the day, it's the same setup. So lastly, let's check out ACAD, and you can see that it's got this week open, but it starts to consolidate, but it's got a top here at 1330s. And you can see that it starts to have a higher low, higher low, higher low, higher low, and then you can anticipate the breakout. So what you want to see here is these higher lows and this top at 13.30. Now, where this is a weak open red to green type play, you can anticipate the red to green and you're risking towards this 13 level at any point in time. 13 being the lower end of the channel and red to green being this prior close mark, and then it doesn't look back until this little blip here, but pretty much holds on all day. Once again, here's the NASDAQ textbook longs. In this particular segment, we're going to start to go over the morning washouts on bullish charts, the morning washouts on a big chart, meaning a big breakout that's happened, but it finally pulled back and it closed towards the lows, and then finally the chase, and when it's okay, when it's not really a chase, but when it's okay to chase a move. So the morning washout on a bullish close, this means that it drops back fast, but it has a really nice close the day before. Usually a stock that's trending well, it's holding trend, it's heading higher, and it looks like it's going to go much higher over the next few sessions. It's very normal for traders to take profit the next day. Sometimes people are holding things for quite some time and it finally starts to break out, so the next morning they already have sells in. So the market opens, all of a sudden it pulls back real fast because everybody's got market sells in because they're finally happy that finally came back and they finally have a chance to go ahead and take their profits or their losses at a better price. And at the same time, some of those people that are riding it up, the first sign of red that they see is the first reason that they should go ahead and take profits. As long as the stock stays green, they don't really consider it. It's just slowly grinding up and they're happy. But once it turns red, everybody starts to think, oh crap, maybe I should lock some in. So once again, this deals with the ABCD type textbook setups that we've been talking about, and you can use an educated risk based on whole and half dollar marks. So let's take a look at Halo. Very nice chart, trending, gaps up, starts to break out. You can see this top here at 7, and it starts to break out again, and then it opens up massively. And then this day it closed pretty much towards the high. And then the next day, everybody decides they're going to take profit right out of the gate. Gaps down and washes right out. So what can you do to make a profitable trade? So once again, the key is to wash out, starts to pull up, holds a higher low, and you can see this top here, right at the 8 mark, and then it starts to hold higher low, higher low, higher low, higher low. You anticipate that breakout. Risk towards the low of day, 790s, so you've got a dime risk for a potential reward of rebounding and heading back red to green, and you just hold until the trend doesn't hold anymore. And then as you can see, it starts to break trend, breaks the prior support at 820, so you want to go ahead and take your profits right here, and it fades off. Or, if you wanted to, since you're up, you can go ahead and hold a stop pretty much at the same price that you entered, and you'd be in all the way through the day towards the 830s. The underlying idea here is to be able to take advantage of the audience that's watching these stocks that had a big move the day before, and then they just pull back, profit taking, which is normal, in the morning, and then you need to wait for them to base, and as soon as they set up and as soon as you can set your risk, it's a good trade to take. And last but not least, the key here as it relates to the red to green is this might be a pullback that isn't near red to green, but it still has a lot of eyes on it, and as soon as it does start to grind back up and set up, it is a good solid risk versus reward. And at the end of the day with day trading, that's what you want, is any good risk versus reward setups. And the key here is you're going to be seeing this stuff on scans. So if you have a scan and you see a big close and all of a sudden the next day it's down 5-10% on profit taking, no bad news, and then it starts to consolidate, there's going to be other eyes there, and that's what you want to take advantage of. Next up is another favorite pattern that can lead to some very quick profits, but is not the best trade for the beginner. It does take some quick action, and you have to be okay with scaling in and scaling out. It's a quick trade, it rebounds quickly, and you need to be ready to take profits. This is when a bullish chart has been heading up for months or even weeks, but it's overextended, it has yet to pull back, and then it finally cracks. It finally pulls back, and it closes substantially red compared to the prior days. Each rebound is met with selling, and then it has lower lows, lower lows, lower lows, and by 3 p.m. it still hasn't rebounded, and it closes pretty much on the lows. So the next morning, pre-market, it starts to open up before 9:30. It starts to trade, and it's red on the day. It's weak. And typically, just like I mentioned in the last slide, people need a reason to sell. And as soon as they see red, they start to freak out or they start to put in their sell orders. So many times when they look at the chart at night and they say, wow, this is the first time it's pulled back in 3 weeks, I should probably take my profits. The next morning, there's a bunch of market sells that we can take advantage of. You need to look at the prior support levels and just have an anticipated level of risk, an educated risk that is going to allow you to size in accordingly. And then if it doesn't bounce, you have an idea of what your risk will be. And just like we've covered breakouts, if you think about it, red to green or gearing and perking, when it starts to break that prior point where it was the top, it breaks out and it spikes. This is the complete opposite, where it starts to break down, and instead of spike, it washes out. And I get the question a lot, what is a washout? And it's exactly the opposite of a parabolic. It's the emotional spike or drop, and that's what we want to take advantage of here. So you can see here, DDD had been moving up for months, from 40, 45, 50, 55, it went straight up to 70. Even the days that it did close a little bit red, you can see that it had lows and then it pulled back. Lows and then it pulled back up. Lows, it got bought back up, and kept on getting bought up. But then finally, it faded, and the dips were not bought back up, and it closed pretty much on the lows, on big volume. If we take a look at what that looks like intraday, you can see it washed out in the morning, rebounded, put in a top here at the 64.50s level, and again the lower high, faded off. Then it starts to put in a top at 62, 62 again, it couldn't, lower highs, faded, and then closed in the lows. So the next morning, what we want to be able to take advantage of, the ideal scenario, is that it's going to gap down. It's going to gap down under that 59 level, and it's going to wash out. Now keep in mind, it was just 70 bucks. It pulled back, and now we want an emotional drop. We want an emotional panic. Everybody starts to grab the oh shit handle, just like if you're in a car with a dangerous driver and you're squeezing as hard as you can. Everybody starts to panic, starts hitting all these buttons just to get out, just in time, just in case it doesn't rebound. So let's take a look. Here it is, it's got the week open. The prior close is right here, 59.50, this white line. This is pre-market, you can see 9 a.m. here. So it goes down under 57, comes back up a little bit, and then this is 9:30, right at open, washes out. So I want to anticipate that long into that washout, because it just dropped 58, 57, 56, $2 a share in a second, because all these people are panicking, and they come back to their computers at night and they see that the stock was down. They say, oh man, I've got to start to take profits. They put in their market sells, the bell opens, and boom, everything washes out. We can take advantage of that. So you can see it started to rebound, consolidate, and head towards the highs. So you can see here, this is the 2-day chart, and you can see the 70 drop immediately down to like the 62 level, and then consolidate, fade off, close around 59. But the key here is this gap down, and this gap down is the emotional part that we want to be able to take advantage of. So you've got that gap down and the washout, the panic, and the rebound, and then it starts to head back up. And the other factor here is this wasn't on bad news. This was just profit taking. This had a big run, and this was the first time that it literally pulled back more than maybe $1 or $2, in about 3 months. So let's take a look at another one, RIMM. RIM, which is now BBRY, BlackBerry, but it had a very big range, and this was the first time that it had pulled back in quite some time. Faded off, closed on the lows, and then the next day it gapped down over $1, and then it washed out in the morning down towards almost 12 before rebounding straight up to 13, pulled back a little bit, 12.50, and then right back up to 13 again. And just to give you another feel on a different looking chart, here you've got that week open in the morning. So this was the prior day, and then this was what happened in the morning. But the pre-market action, you can see right here, just like on DDD a couple slides back, where it had already gapped down $2 pre-market, here it's gapping down 13.60, 13.40, 13.20, under 13, and by the time it opens, not only does it wash out, but it washes out, it's under 13, and it washes out almost to 12, almost $1 per share. It's about 80 cents. What we're looking here is a washout compared to the prior price action. It's all relative to the prior price action. If it's grinding down, that's fine. We don't want to touch it. As soon as the stock starts to wash out compared to the prior price action, that's when we're interested in. And that's exactly what happened, that 80 cent washout before it immediately went straight back up to 13. And just to see the daily chart, just to get an idea here, you can see that it does this quite often, and we had gone over this chart before, but let's even go back a few months. You can see this week open, and then as we went over with the candlestick charts and what they mean, you can see that it actually opened, it washed out in the morning, and then it came back and closed towards the high. So this is the candle that we were taking advantage of in the last chart. You can see here, it opened under 13, washed out to the 1220s, and then came back. That's this candle right here. So here it is, it had that big run, and then it finally had the first big pullback that was not bought back up. And you can see that they had this big pullback this day, but it was bought back up. Then it opened back up, and it washed out. So it had a very weak close, and then the next day, it gapped down, it washed out, and then it rebounded. And this is just a perfect example of taking advantage of emotions. You can see pretty much even the strong days, it closes very strong, and the next day it opens up higher than the prior close and takes off. Closes towards the highs, gaps up, closes towards the highs, gaps up, closes towards the highs. This is the point of equilibrium consolidation around that 18 that we discussed. Then it started to fade. Then it gapped down, faded. Then it had a strong close, gapped up, weak close, weak open. Then followed by a strong rebound. As you can see by that chart, it did come back pretty strong. And the next day, gapped up and continued on. So the key here, what you want to pay attention to, is the days that it has big price action relative to the prior days. If it's just sort of grinding around and it's got the normal range that it has every other day, you don't care. But the days that it has that massive candle, on the upside or the downside, is the days that you want to be able to take advantage of the emotion. And you can see the same thing here on DDD with this massive candle. Next up is to chase, and when it's actually okay to chase. You know you want to be in the stock, but it's starting to run away from you. You don't want to miss it, but at the same time, it's not exactly being patient for an entry. It pops up, but it doesn't really pull back too much, and it starts to consolidate. It looks like it's going to go again. This is where you need to be able to use the support and resistance on a daily chart and be comfortable with chasing it intraday, but using chase size. And by chase size, I mean using a little bit less size so that in the event that it does pull back, in other words, had you been patient, you would have got a better entry, you can still add in without adding into a bad position, without already being in over the top as it popped. Now, if you go way back, you remember I said averaging down is a very bad thing, and you shouldn't get used to it, you shouldn't do it at all. But in this case, the difference is you're going in with a plan, you're using less size, and you're giving yourself the room so that if you do need to add, if it does pull back, you're not adding into a bad position. You have a small amount because you chased it, It pulled back, it's starting to consolidate, it finally looks like it's about to go again, and you can add into the full size with a set risk. Let's take CTIC for example. This is a former runner. Stock has ran from like 20, 30 cents to $2, $3 before. Had come all the way back down, as you can see, started to fade off, and it went down to 120. Put in a pretty solid base there, and then started to put in a top at 140, another top at 140, started to fade off, but it's holding a higher low compared to where it was before at 130s. So now we wake up, and all of a sudden the stock is gapping up, and it has volume. So we want to ask ourselves, is it okay to chase? So it gaps up in the morning, it's 9:10, 9:30, and market opens right here. Is it okay to chase that 140, 145, or should you be waiting? And the fact is your risk is going to be based off of 130. So what you want to do is, sure, go ahead and chase it, but make sure you leave yourself room in case it slams back down to the 137, 135 level, so you can add in without going over the top, without adding in more size than you would normally play. But at the same time, it gives you an opportunity to catch the momentum to the upside. We traded this one. It was about 9:30 to about 10:10 or 10:15 that it held gain. So it was about a 20-30 minute trade, but it went straight up. And had we not chased it and been comfortable with the fact that the daily chart has been consolidating for months at around $1.30, we would have missed the entire trade. And again, if you look right here, you can see, had you missed this move, pulls back, starts to consolidate and hold lower highs with the top of this 152 level or so, and then you can anticipate this break and get the upside right here. But that's not the point of this part. So let's take another one, a late day type move. ROSG was a recent runner, and it's been consolidating around 320 for quite some time. So you know right away that your risk is going to be based off that 320, 330 level, whatever the intraday risk is, but your hard stop, if it breaks that 320, obviously it's going to be a trend reversal because it's been holding this level for quite some time. So you can see this base here and then the big volume. Intraday, here's what it looks like. So it's been kind of grinding around, and then all of a sudden it pops. Now, the only way that you would be able to catch this upside from 330 to 345, 350-ish is if you were in before and just kind of anticipating a move. Probably not going to be in it. So what you have to do here is chase. So when is it okay to chase? So we know that this is a former runner. It's ran in the past. It has a big history. If I go back to a 6-month or a year or 2-year, you can see that this stock has actually ran from 2 to 20, back down to 5, back up to 10, back down to 3, back up to 7, and so on and so forth. So the point is we're familiar with it. We missed this move. Big volume comes in, but it's holding. So it's holding, it's starting to consolidate, it hangs up there for 5 minutes. So is it okay to chase? Yes, it's okay to chase. You're not going to go in with as much size as you typically would off somewhere where you have a set risk versus reward, but you're going to chase some. You're anticipating further continuation because it's been consolidating with a base here at the 325, 320 levels for quite some time, and it's due for a run. So it takes off and you can capture that upside. Here's another chart. Now, this was one that we did take, and we ended up selling for about even. But the point is it's the same situation. It's a beat chart. It's been consolidating around 5, and it started to go. At some point, this thing's going to have good news, and it's going to carry it. And this downtrend is going to reverse, and it's going to start into a normal uptrend that might last a couple weeks. So let's look at it intraday. Pops up, and unless you're in it right here, you're not going to be able to catch this move unless you just happen to chase it 515, 520 and you just jump in. But the point is unless you're in here, you would not be in it, and you're in a position where you need to chase again. So are you okay with chasing? Sure. But you're basing your risk off this level and you're using a little bit less size. So normally, let's just say you might use 2,000 shares or 5,000 shares. Well, if you're chasing, you might want to only use 1,000 or 2,000. And in that way, if it does pull back and it starts to consolidate around 510 or 505 again, and then it starts to head back up, you can add into full size and capture that upside that you wanted with the full size with a set risk. But while you're chasing, you want to use a partial size. So as you can see here, you can see the baseline consolidation at 510 range. So you know right away that when it pops up, sure, you missed it, but when it pulls back and you're going to end up chasing that long, you know that you want to base your chase size off this level. So you want to be okay with the share size that you choose if it were to pull right back down, just as fast as it went up. If it were to slam back down just because maybe a newsletter bot or maybe some news article or a tweet or something lit this up, and it was actually nothing that really mattered, and then it ends up just sinking back, and sure, you might be down a couple bucks, but you're not going to be in full size, so you're not going to be upset, and it's not going to be a major loss. Once again, just to review these charts, I want you to notice that I'm focusing on charts that are beat, that have been waiting for that potential reversal, that potential trend change, and it's got a set risk. You can see the same thing here on ROSG. It's been beat. Everybody's waiting for that time that it's going to finally reverse. You wait for the big volume. And the point with this is the risk versus reward. It's much more rewarding. If it does reverse, if it does take off, you have that set risk off the consolidation. And the potential reward, if it does take off, and it does reverse, it's going to pay you 3 times, 4 times, 5 times the risk. You're only risking a dime on a chase like this, or maybe 15 cents, but if it does start to take off, which it did, you're going to have a whole dollar of upside.
Now you know how to anticipate a red to green play. And remember, it's a stock that's been in play with a big range the prior days. We don't care if the stock is up 10 cents the day before and it's just going red to green on the day. We care about stocks with an audience. We care about where the traders are and how many are watching it. Typically, red to green plays have large surges and they push from red to green, but you need to remember to lock in at least a half, because sometimes that might be all they do. They might only get that one push towards red to green, and if they fail, you're going to wish you had locked them in. And rather than compete with everybody once you know that it failed at red to green, it's always good to go ahead and lock them in when everybody wants it, when everybody thinks red to green is coming. And you need to wait for a base. You need to focus on what we've learned in the prior chapters, the ABCD type setups, and couple it with red to green type trades to get the best move. Remember, stocks can consolidate. Week opens in the red to green. Remember, formally beat charts. Former runners that have really sold off and then start to bounce off the bottom the first day. They pull back, they consolidate, they start to hold higher lows and start to grind higher. There is interest each week open with a base risk unloaded. You now know how to take advantage of a washout on a bullish chart that's breaking out. Many times there's profit taking in the morning after a big day, and once it's based, you've got that nice rebound. The more advanced type of trade, as I went over, is buying into the washout. You don't have that set risk versus reward, but you should save it for when you're a little bit more familiar with trading. But for me, now you know how I take advantage of that morning emotion and the morning panic that market sellers pretty much create before a rebound back up. And last but not least, contrary to everything I say about being patient and waiting for the trade, it's okay to chase sometimes. But you need to know how and why and when it's okay. And last but not least, contrary to everything I've said about being patient and waiting for the trade to come to you, now you know when and what the charts look like that are okay to chase. How you can decrease your size and be able to still make a profit at the same time. In Chapter 6, we're going to dive into some of my most favorite types of charts and some of my most profitable trades. Parabolic shorts. Parabolic shorts is taking advantage of the price action. Not just a stock that's popped up on any given day, but what actually makes it parabolic. What actually makes it faster relative to the prior price action. What is it that you need to focus on, and how can you profit from it? The most important part about actually understanding the parabolic shorts is understanding the daily chart and the overextended charts, the overextended consolidation, and the difference between the two. Overextended charts are charts that have been going up every single day, and there hasn't been a pullback. They're getting overextended. It's very normal for a stock to go up, and it can continue to go up and up and up. However, at some point, it will pull back and consolidate before it heads higher. And that's all we're looking to take advantage of. Many times, a stock will pull back, and then it will start to consolidate at a much higher level. So although the daily chart is overextended, you need to be able to adapt and understand what this consolidation means and how to avoid walking into a trap. Some of the most favorite ones as far as being prepared for the market day is the power close, gap up, parabolic. This is when there's that big close, the next day it continues the momentum, gaps up, parabolic, and I'm looking to short into that action. And last but not least, intraday parabolic. This is the price action that actually happens intraday versus coming to the market prepared for it, having it gap up and rip, and then sit back. This actually happens during the day. So stocks that have been going up all day, but have yet to pull back. Now, for everything that I've mentioned in this Chapter 6, that does not mean that they cannot keep on going up. That's why shorting is risky. So what I'm going to do in this chapter is show you exactly what to expect, how to take profits, what to watch out for, and the mistakes that most people make with these trades. However, these are my most profitable types of trades.
Next, we're going to go over NASDAQ textbook shorts. Now, I've got them listed out just like the longs here. Parabolic shorts, follow-through momentum, and failed follow-through momentum. Late day fades, lower highs, and what to pretty much watch out for, the slow grind and what you need to stay away from. So first and foremost, I'm going to go over my favorite, parabolic shorts. Now, this is not the best for a beginner, so I'm going to get it out of the way. I'm going to go over it. And once you have full understanding of the rest of them, circle back and watch this again, and you might be ready for it. The difference between parabolic shorts and the rest is the rest that are listed here give you a set risk first reward. You wait for lower highs, and you have a set risk off that high. You wait for it to break out and then fade off, and you have a set risk based on where the top of the channel was, for example. Again, I'll go over all these. But parabolic shorts is actually shorting into the momentum. You don't have that high a day as a risk. You don't have that former top as risk. You're actually just anticipating it as it's breaking out. And the risk is it could keep on going. So what do we look for parabolic shorts? The ideal chart is overextended. It's something that's been heading up for a long period of time. It could be days, it could be weeks. But it is yet to pull back. It's normal for stocks to go up. Every stock that goes up does not need to come down. However, it is normal for stocks to pull back, consolidate, and start heading back up. It's abnormal for them just to go straight up without any pulling back. And this is what we aim to take advantage of. I have a lot of subs that come into the chat room and think that pretty much anything that pops is a short. Stocks don't go up. Anything that goes up should come right back down, and that's just not the case, and you can really get hurt that way. So what I want to do is show you a couple examples and show you how to anticipate, how to have an idea, a mental stop in mind, and what happens if you nail it, and then it pulls back, and then it starts to slowly grind back up to where you short it. What do you do with it? The main thing that I want to focus on with these parabolic shorts in these charts that I'm going to show you is not necessarily how to actually trade them short yet, but just to understand exactly the type of chart that I consider overextended and what type of chart I do not consider overextended. And understanding the difference between that is going to help you out quite a bit when determining what type of short you should be looking for, whether you should be looking for a parabolic type short or whether you should be looking at something once it starts to fade, once it starts to break down late day. And that's the main difference between these charts. So as I go through all of these, you're not going to understand how to short right away. I just want you to get a feel for the charts that interest me as potential shorts. So let's take a look. This one first, NENE. Now you can see this stock has gone straight up from $1, $1.20, $1.30, $1.40, $1.50, and it starts to go parabolic. That's the type of chart that I'm interested in, something that has yet to pull back. Same thing here, AAMRQ. Starts to grind up, it's normal, it's trending, pulls back, goes up, pulls back, goes up, pulls back, consolidates, starts to break out, goes through 4, 5, 6, 7, no pullback. Another one, RSOL, takes off. This is another one, parabolic, starts to fade back. Then it takes off this day again. Major volume, but parabolic. It was just 2. It's a piece of crap company. It's just breaking out because other solar companies are hot. And we'll be able to take advantage of this price action. 2 to 3 to 4, all the way up to 7 in 2 days. What a parabolic and overextension is, it's compared to the prior price action. It speeds up relative to the prior price action. If it's normally running, just like AAMRQ, if it's normally running 10, 20, 25 cents a day, and all of a sudden you start getting 50 cents, 50 cents, 50 cents, $1. That's starting to speed up relative to prior price action. You can draw a line under this, and you can see it starts to veer off and head straight up. So what we want to do is take advantage of this momentum, and as you can see here, Tesla, where it goes straight up again, straight up. This prior price action, it was just slow grind, slow. Gap up, rips up 10 points, rips up another 10 points, gaps up the next day, almost hits 100, and then pulls back. And this is what we want to anticipate. We want to anticipate that action, that emotion, everybody thinking that it's going to go to 100, and then as soon as it pulls back, it dumps fast. Again, another one, SCTY. This was part of the solar run in the past year. You can see it starts going up 15, and then it puts in a top at 20, same thing, grinds up to 25, pulls back, and then it just starts to go. You've got your normal $1 to $2 move type day, and all of a sudden you get almost a $10, $12 move, pulls back, but it's holding trend, and it starts to parabolic again. We want to take advantage of this emotional move. We want to take advantage of this squeeze. You can see here it goes up through 50, which, like we talked about, is a magnet. Once it starts to break 42, 43, 45, and it starts to be 47, 48, your next psychological target in your mind should probably be 50. It's probably going to want to test 50, go up and back under, and that's a trade that we want to take. And as you can see, it did exactly that. It went up and over 50. The next day it went up and right under 50 and down $5. Another example is BGMT, and BGMT had some major volume, went up, closed towards the highs, then it opened up the next day and it ran to 450. So this normal price action is pretty much just kind of fading off each day, 10 to 20 cents, and then all of a sudden it goes up over 100%, and then the next day it runs up to 450. It was just $1.50, it ran up to 450. Compared to the prior price action, it took 3 months to come down from this 4 level down to $1, and it took 2 days to get right back up there. And take another example here, WHX. This was a recent one where it just sort of starts to grind slow and steady. You can see the range each day is probably about 10 to 20 cents max. Slowly and steadily up. Steady, and then it starts to parabolic, probably on a 10 magnet. But the key here is these 2 days, it did not pull back intraday. And you can see on this intraday chart, it's slow and steady. And there was never really a pullback to shake out the weak hands and really maintain a strong move. So what happens is when things are going straight up, it doesn't give anyone a reason to sell. So what happens is they just hold, they hold, they hold. And then when it does start to pull back, everybody panics. Everybody's got to be out at the same exact time. And that's when you start to get the really fast cracks. And as you can see, this one slammed right back down when everybody decided, oh crap, it's not going up anymore. So what I want to focus on next is the overextended consolidation. What happens when it does go straight up? We think it's a short, but then it starts to hang on. There can be a second wave. It is normal for a stock to go up. It's important to see these types of charts because I want you to see the difference between a stock that's going straight up, when it rips up, pulls back, and it consolidates. That changes my perspective on the move. It's no longer an immediate short into any pop because that next pop can be a secondary squeeze from all the people that didn't recognize the consolidation. It's no longer taking advantage of emotion. I like to take advantage of all those people that are all excited. It's going up, it's going up, it's going up, and gotta buy, gotta buy, gotta buy, it's going to the moon, and then all of a sudden it slams back down. I'm looking to take advantage of the stocks that go from 425 to 450 to 475 to 5, and then they start going 6, 7, everybody thinks 10. I want to take advantage of that morning emotion when everybody gets all excited and the first point where it hits red and they say, oh boy, should I take profits? So let's take a look at a couple different charts. And I'm going to get into this type of shorting later on, but I want to show you the difference between the two charts. So you can see this IRWD goes straight up. And we typically would want to short it, probably one of these days. And this day actually was a pretty good short, but it pulled back, and then it started to go back up. Went up, pulled back, started to go back up. It can support a secondary move. So at this point, you need to wait, and you need to only short late day phase, which we will cover later. But what I want to do is focus on this almost $10 to $15 move, which is a 50% move. But where it goes up 40%, it pulls back 15, 20 cents, consolidates, and it hangs on. So you don't want to just get short at any moment in time because you're going to end up getting squeezed. And all these people that think that this was too big of a move end up getting squeezed out through 15. LLEN was a great short. We shorted this day, and it faded back very, very nicely. However, towards the end of the day, it started getting bought back up. So it put in a floor here at 340. Then over the next couple of days, it had pulled back again, and it held that same floor. So rather than thinking $2 to $4 is huge, it's got to pull back to 3, you have to change your thinking because it's holding higher lows. It's holding trend, and it's consolidating at a higher level. And as you can see, it supports a secondary move. And all those people who were betting the house that, hey, this thing should go back to 3, why would it hold up this long? Guess what? Breaks through 52-week highs and marches on to 5. And these are very easily identifiable during the intraday. For example, if you go back to the whole ABCD type pattern, when you start to see it slowly grinding back up, that's when you know to stay away. And the same thing happened with AMD. And AMD went straight up 260 to 380 pretty fast, ton of volume, 80 million shares, so it was very liquid and you were able to trade it. But it started to pull back, and you can see that the days that it had come back, it got bought back up. Came back, got bought back up. And you have to notice that it started to consolidate at a higher level. As you can see, the day after this candle, it ended up holding a higher low. And when it broke that, it went on to break more highs and squeezed everybody out that thought, hey, this has got to pull back. There's no way that this thing holds. So again, this is the action that I want you to see. Is you've got this parabolic move where the stock's going straight up and it has yet to pull back. But when it does pull back and it hangs on, you have to recognize that. YRCW is another one. Just like that TSLA, the Tesla example that I gave you, it was a great, it gapped up, then gap up parabolic, and then the next day, gap up. We actually took advantage of this in the chat room, and it slammed back down. It was a great parabolic chart. But stop looking at, hey, it was just $8 and now it's 15. It's got to pull back because you have to watch the price action. And as you can see, a higher low, a higher low, a higher low with a top at 15. Well, what happens if 15 breaks? Guess what? Squeezes. So you can see at this chart that there was the top of the 15 where it put in there, and then right here at 16 it broke the former highs. So this is what turns an overextended chart into a prospect short, but not a layup like we typically would anticipate, like these gap up mornings and this gap up morning. Next we have AXL. You've got that nice move, 12 to 13. It consolidated around this level, and then it started to break out. It went 13, 14, 15, 16. Okay, great move. Well, how does it pull back? Pulls back a little bit, gets bought up, pulls back a little bit, gets bought up, starts to put in that top at 16. But what happens when it starts to grind and higher lows, higher lows, higher lows, and it breaks that 16? It has that post-secondary squeeze. And you can see that with the lines here where the top was, started to grind up and pop. So now you've got a basic understanding of the charts that I look for that I consider overextended. You understand the difference between an overextended chart and a chart that has overextended, but it's pulled back a little bit, started to consolidate, tapping on the prior highs, and then becomes a new breakout stock. Despite having that big run and holding the gains, it still can go higher. And being able to distinguish between those two charts, which we just covered, is very big because everybody always thinks that just because the stock has ran, it has to go back down. And that's not the case. If it consolidates at a higher level, it's going higher. So this segment, I want to focus on those charts that are just going straight up, not the consolidation type that might head higher, but the ones that literally have just gone straight up, and I want to take advantage of that morning emotions. I call this a power close, gap up parabolic. So let's just say the day before the range was $1.50 through the entire day. When the night before it closes with a bang, towards the high days, all of a sudden we're 2 minutes into the open, not only did the stock gap up 70 cents, it just ripped $1. That move is not sustainable. And that's what I look to take advantage of. I look to take advantage of all the people that are market covering, market buying because they think it's going to the moon, and taking advantage of all that morning emotion. Because a lot of people don't consider taking profits until the market gives them their first reason to. And that could be either a pullback or it starts to go red on the day, things like that. But when a stock has gone straight up and it gaps up and starts to rip and it breaks out in a manner that's much faster compared to how it was moving before, like I said, it's not sustainable. And a lot of times, sure, the stock can go higher. It can, and it probably will. But that intra-minute, that intraday, it's not sustainable. And it's going to pull back, and then it's going to consolidate, and then it's either going to head higher or head lower. But what I look to take advantage of is that emotion out of the gate, and then where it sits right back, and then it consolidates. And I want to be able to take profits from that emotional pop to the pullback, lock in at least half, and then see where it goes. Sounds pretty easy, and the reason why I said it's the riskiest of the type is because you don't have a set risk. You're not basing your risk off the high day. You're not basing your risk off a former high, but rather you're anticipating it. You're anticipating it based on whole and half dollar marks. You're anticipating it on, let's just say a stock is going up from 42, 43, 44. Then it starts to break out, 47. And you think there's probably a magnet on that 50 break. I'm thinking it's going to probably pop through that 50 psychologically. That's what everybody's thinking. And then everybody's going to say, okay, it's over 50 now. Now what? And then it's going to sit right back under it. And that's what I look to take advantage of. But, again, what if it goes to 60? Now, 95 out of 100 stocks, 99 out of 100 maybe, usually always follow the same pattern. Emotional squeeze and sits back. Occasionally, one or two may continue to go. And that's where your rules, that's where your ability to cut a loss comes into play. And that's why if you're new and you're not familiar with it, and the action's flipping around all over the place, where you could run into a problem if you're unfamiliar with these types of trades. So let's take a look. This is Jazo. Jazo was a solar company. It started running with all the other solar companies that were running this year in mid-April to early May. And they had earnings, and it gapped up this day on earnings. It ran like crazy, 650, 750, 850, 950. The next day it opened over 10, hit 1150 almost, and then finally pulled back. So here's Jazo intraday, and as you can see, it ran from 6 to 7, consolidated a little bit, ran through 750 up towards 8, consolidated for most of the day, and then 2 p.m. to 4 p.m. it ran from about 8 to 9, about 940 or so it closed at, 950. The next morning it gapped up over 10. So this is pre-market, as you can see, May 21st, and this is about 7, 8 a.m., and it's already over $10 a share. Then, within about 15 minutes, it's over 10.50 and 11. This is parabolic relative to the prior price action. You can see all day it took to get up $1 and then another $1.50. This right here took about 15 minutes. So this action right here, 9 out of 10 times, is not sustainable. And that's what I look to take advantage of. What I base my risk off of is the whole and half dollar marks. I let it speed up, and then I let it test each one, see how it reacts. 10, 10.50, 11, 11.50. 11.50 was the only point that it tested and pulled back and retested and pulled back again. So I started into the parabolic. Then I started to fade, pulled back $1. And that pullback was fast relative to how it was trading the prior day. So I took part of the profit. Then, this is 9:30. This is right at open. You can see all the volume that spikes up. It's at 10:50 pre-market, 10:60. Rips up, 11:30. This action is faster than the prior price action. And not only that, now you have a set risk. And this is kind of getting into a little bit of what I'm going to go over later. But now, you can risk into a pop with a set risk towards the prior highs, around 1150. But this action is parabolic. I look to take advantage of this, and many times it's met with the same reaction to the downside as it had to the upside. Then it can consolidate, and it may head back higher or it may head back lower. But most of the time, it breaks out, pulls back, and consolidates where it started to break out from. Here's a closer look at it, and you can see the price action starting at 8, how it jumped from 10 to 10.50, pulled back about 10 cents, and straight up to 11.50. Put in a double top, and then started to fade off, and then again right at that 9.30, like I was telling you, pops right up. Now you can risk based on this, and fade off. And this is another tool that I use. Let's just say I didn't take this trade pre-market. When it pops out of the gate, many times I base my risk according to the pre-market price action. And that's how I find my risk. Now you have to remember, this may not look all that overextended, but you have to remember where this chart came from. If you remember the day before, it was a 550 close, it gapped up to 650, it ran to 950, and then you've got this action. So it's over a double in a day and a half without a pullback. There's been no reason for anybody to sell, and this is the first time it starts to pull back, and the same thing here, and then you've got all the profit taking in the world. Here's another example with YRCW. You had close around 770s, 780s, then it broke that prior top, not only the 8 but the 9. This was long-term resistance. Gapped up over 10. Gapped up to 12, and it ran straight to 15. The next morning, if it continues to open, gap up, there's a good chance it's going to gap up, rip over 16, and then pull back. That's exactly what happened. Opened up, we shorted into the pop, and it pulled back. Same idea here on OSTK. This actually happened a few times here, each of these days, but it ended up coming back towards the highs by a close. But as you can see, ripped up towards 26 and pulled back. And let's look at it intraday. You can see it's got that morning price action. So it went 25 to 26.40, $1.50 in about 5 minutes before pulling back. And when you have an overextended chart like this and it pops up $1.50 in 5 minutes, there's a good chance that it's going to pull back and consolidate before it heads higher. Doesn't mean that it can't go to 30. It just means that there's a good chance that it's going to pull back, consolidate, and either head higher or lower from there. Now here's Tesla Motors. This brings in another thing that I use, whole and half dollar marks like we've talked about quite often. So you start to think, okay, it's at $59, $59.50. What's the next psychological price target that makes sense, that everybody's thinking it's going to break once it breaks that 55? It's 60. Everybody's thinking 60, 60, 60. Okay, so you have to develop a plan. 60 parabolic probably pops up, and then it starts to fade and retest that 60 and consolidate. So that's our game plan the night before. Let's take a look. Gaps up, rips, sits back down to 55. Now let's look at the intraday. You've got that gap up over that psychological target of 60, moves up on air, literally 60, 61, 62, 63, and then starts to fade, fade, fade all day. Right back under that 60 mark. So this is how I focus in on those whole and half dollar marks, those psychological price targets, the 60s, the 65s, the 70s, the 55s, all the things that we've talked about. And not only that, sure, you've got this big morning move, parabolic, then it pulls back and you've got a lower high, pulls back again, tops out again and starts to fade. So now, if you miss that parabolic, you've got two other options, which again, lower highs is something that I'm going to go over in a little bit. But now you've got that set risk on 63s, and you can risk accordingly. Here's another chart of Tesla. You can see here that it's got that gap up. The next day it goes up another $10, pulls back a little bit, gaps up, runs again. Now it's sitting just below $90, which is again another one of those 75, 80, 85, 90 type levels that we're looking for. So the ideal scenario would be a gap up through 90, short into that parabolic, that emotional spike in the morning, and then ideally it's going to fade back. So you can take a look at, this is the actual intraday chart. You can see that each parabolic move was actually met, with a pullback, and then again here, pull back, started to speed up, pulled back. What I want to focus on is this is a nice powerful move. Keep in mind, we've got that overextended chart, and then after hours you can see that this is 4 o'clock, so the market closes here right around 87, 88 bucks. And then it continues on after hours, and it's over 90. So there's a good chance the next morning it's going to gap up, just like we wanted, over that 90. And that's when we're going to be interested in any $2, $3 spike move like this to short, because there's a good chance that it's going to pull back. And it doesn't mean that it can't go higher, but there's a good chance that it's going to pull back and consolidate, sort of like this, before heading higher. And you can see it did exactly that, gapped up right over 90. It ran to about 96, 97, and then slammed all the way back down to almost 80. So you almost had a $15 to $17 pullback intraday on this overextension. And the reasoning, because it's gone from 55 to 96, 97 without even pulling back once. Here's another example. This is a former runner. We know of this one. It's ran before, and it actually just ran the prior days, right up to from 140 to 260. Then it faded back, and then you can see the volume came back and went right back up to the highs and topped out. So the ideal scenario would be a gap up. The next psychological point is 250. So ideally, it would gap up through 250 and run through 3. So that's exactly what we got, but we got a little bit more. And you can see it actually went up all the way to 450. So what I want you to look at is this intraday chart. You can see this is the late day move where it went up to 260 and then consolidated right below 250. Then in the morning it spiked up, got that nice parabolic, and then pulled back. So this was a nice short. We actually did take it short in the morning, but then it pulled back and it was consolidating and it started inching up towards that pre-mark again.
So we went ahead and covered. We took the profits. Then it started to go back up. And that's the difference between a parabolic move and something that you have a set risk versus reward on. Because you don't know where it's actually going to top out. And if you're stubborn and you decide, well, I'm going to hold this and just see where it goes. When it's in go mode, when it's parabolicing, and when it's just breaking out, this is what can happen. That's why I said that this is a risky strategy. It's not for beginners. And you have to know what you're doing. You have to be quick. If you start to see it consolidating and it doesn't just pull right back and it ends up holding the gains and starts retest towards highs, you need to take it off. You need to take the profits or take the small loss and move on. So then the ideal scenario, as it starts to break back through 3, you've got that 350 and hopefully it breaks through the next whole number in parabolics. And that's exactly what happened here. And it actually started around 370 and it went straight up. So we get a nice little short into the parabolic. And again, at this point, you kind of have to have the idea that 5s might be risk. So you might only be shorting 500 or 1,000, 2,000 shares depending on your risk, knowing that you might be risking $1,000 on this trade, but there's a good chance that you're going to make 3,000. Or you might be risking $200 on this trade, but there's a good chance you're going to make 600. That's the type of thought process that you need to have when going over these parabolics, because there is no set risk. Anything is possible, but most of the time they pull back and then they consolidate. And even like this one, it pulls back, it consolidates, it starts to go a little bit more, but it ends up starting to top out at 4 and fades off. We'll take a look at another one. This one, RCON, didn't do as crazy of a parabolic, but it still did open up in the morning, had a strong move, and it ran through that whole number, which in this case, obviously, we'd be looking for a gap up in any parabolic through 3. So that's exactly what we got. And you can see this is open 9:30. So it had a nice little gap up right around 3. Went up, pulled back real quick. Nothing too much to shout about. Started to go again. So the next psychological price target that you're looking for is 350 over and under. So it goes up, it fails at 350, comes back down, retests, it comes back down, retests. So that's when we're interested in the short. It's got that big move, 60, 70 cents compared to the close, when, I had that big move yesterday, but 120 to 270 without any pullback, and then another 70 cents up. And so then we're obviously interested with a risk based on that 350 level. And you can see it ends up fading off, and it ends up looking like this at the end of the day. So this is what we consider a former runner, going back to the terms that we've already learned, something that we know has ran before. And now, in the future, when we see this thing starting to break out again, we know that, hey, this thing can run. So it's already in our brain. So next time we start to see it break off maybe 150 and there's 1 million, 2 million shares traded, it rings a little bell that says, hey, this thing can go to 3 or 4, so don't underestimate it. Don't short it too soon. So once again, we're looking to take advantage of what the momentum traders are doing, the emotions that surround a move. At the end of the day, most of these charts, most of these companies are all junk. At some point, the momentum's going to rub off, and it's going to come back to reality. And that's what we're looking to take advantage of. We're looking to exhaust all the momentum traders, exhaust all those idiots that just chase. And when the speculation is at its highest, we want to take advantage of that. And that speculation is the carry-through momentum, the carry-through interest, the carry-through message board pumpers that make everybody believe that, hey, this thing's going to go to $5 or $10, and then in the morning it ends up ripping to 350, and then it ends up sitting back on. Once again, it does not mean that it can't go higher. We're just taking advantage of that morning trend. One other thing to point out with this is, had this move held and it pulled back and it started to consolidate and it started to go and it started to break that prior high and retest 350s and actually break out, what's very possible is the same move that we saw just a minute ago. You can see on ACUR, it had that same move in the morning, and then it pulled back, and instead of breaking down like RCON did, it ended up holding, consolidating, and it started to go again. So what happens there is you've got the follow-through momentum traders, those that are buying because the trend is holding. You've got the believers, those that are buying because they think it's the next, who knows, the next $10 stock or $20 stock. And then now you've got those stubborn shorts that shorted. They think the company's a piece of crap. They're not paying attention to price trend. And instead of covering, they've decided to hold. And then all of a sudden they start to panic. and then you've got that emotional short squeeze that you can take advantage of. And this is pretty much what I call a secondary squeeze. Once a big move holds and it starts to consolidate and it breaks out, I wait for it to parabolic, because you're going to get one, because it's filled with emotions. Next up, we've got Solar City, SCTY. It had this nice breakout through this 16 top that we went over before with the longs, where you've got that multiple time frame type breakout. You've got a top, and then it starts to slowly grind up closer and closer to that prior top. And then it finally busted it. So you've got 15 to almost 16.50. The next day it gaps up $1 straight up to 18. And there's no real pullback yet. So the ideal trade again is follow through momentum towards that next whole number in any parabolic move, meaning any candle, let's just say the first couple minutes, that's more than or relative to the entire day's range the day before, is probably going to be met with a little bit of selling. And that's exactly what we had here. We were just anticipating a gap up and parabolic and short into this spike, very low volume, but it shot up almost $2 from the close. And then it sat right back down and faded off. And that's what we aim to take advantage of. And as you can see, the same pattern again. You've got that strong gap up again, and then it sits back. And you can even see that it did it here. Gap up, and then fourth day, came right back down. The next idea, same type of thing. I look for big price action, but then what if it goes up on low volume? And it's all a late day move, and then the next day it opens up even higher, and it's got all kinds of attention pre-market. Is it going to hold? Now sometimes you get that nice parabolic move straight into the close, and then you can take that into account the next morning if it gaps up. It won't necessarily have a gap up parabolic, but it'll have that parabolic move the day before, and then it gaps up, and you can take advantage, because a lot of times what happens is the price trend goes back and starts to consolidate where it started to break out from. And that's exactly what happened here. And you can see very low volume ended up taking the stock from the 260 level through the threes, through 360, whole buck, and up towards the fours. And then the next day it was up over 420, 425 pre-market, and it started to fade off, and then it ended up washing out. But this whole entire move just kind of skipped up into the last 15, 20 minutes of close, and there was no sellers around. The first instant that it shows red, any pullback, all the sellers that were like, oh, this thing's going to go to the moon, finally have a reason to go ahead and take some profits. And that's exactly what happened. And it slammed right back down to the lows. Now let's take a look at CTIC, CTIC. Now this thing has faded all the way down, started to rebound, and then slammed back down to the lows at 180. Found a little base here, and then the next day it opened up on some good volume and popped 180 to 230 or so. It hit 240, but it settled around 230. The next day it capped up 250, ran to 270 or so, pulled back to 255 level. And then again, it gapped up that day, ripped to 360, pulled back some, and then ended up coming back for the close. And obviously, both days here, the goal would be a gap up, and then it pulls back. So that did happen this day. But it ended up coming back towards the end of the day strong. And then the next day, we'd hope the same thing again, gap up, hopefully a parabolic towards 4, and then it sits back. And that's exactly what we got. We got a gap up, and this time, instead of actually closing strong, it closed pretty weak near the lows. You can see this is the intraday move. Now, this is this first gap up day right here. This gap up towards 290 level 3, and then it ran to 360 and pulled back. And then the second day is this day. So you can see that big move, 290 open, runs to 340. So you can short any parabolic. Your ideal scenario here would be 350 over and under, and then it snaps back and fades. Starts to consolidate and ends up coming back. So the big thing to take a note here of is morning motion, pulls back, and then when it starts to grind higher and higher, you don't want to keep shorting. Sometimes 2, 3 p.m. plus, it's best to wait till the next day. So that's exactly what happened. So we got that gap up towards 390, pulls back. You might not necessarily have gotten this one because you were waiting for 4 and parabolic. So it slammed back down, started to go back up again, lower high. So you can go ahead and start shorting and base your risk off of 4. Then it faded back,
came up a little bit, faded back again. So we ended up having a really nice trade here, but I don't usually stay in through all this, lull. I take the big win and then move on. Just to take a look at it, what it looks like on the 5-day chart. This is before anything happened at 180s or so. Then gap up, it ran, pulled back, consolidated, ran again. Gap up, pulled back, consolidated at 250, ran again. Then we've got that gap up and morning emotion to take advantage of, and then the gap up and pop to take advantage of, and then it finally washes out. And it ends up fading all the way back. So next is NEWL, and this is an old favorite. And obviously the ideal here would be a 2 gap up and parabolic, since that's the next psychological target. And that's exactly what happened here, and it gapped up over 2, ripped through 250, and then it slammed back down. And you can see that on the intraday chart here. It opened relatively flat, and then it just took off out of the gate. So this is obviously some nice parabolic action, 190 to 270 in a matter of a couple minutes. Then it faded, and had I short this, there's a good chance I would have covered here at least 1/2. And then otherwise, if you didn't get the short, you can always reshort based on this prior high. As long as it doesn't break it, then you can go ahead and short and have a set risk first reward. It ended up fading off all through the day. And you can see exactly what this looks like on the daily chart. The next day it slammed down even more, but you've got that big morning move, gap up parabolic, and then slams back down, and then weakness. And this is what it looks like on the 5-day chart. Came out of nowhere, takes off, rips, gap up parabolic, fade, and then the next day slams down. This is the emotions that we want to take advantage of. 50-cent run to 75 to $1, and then it just rips up to 275 on, not crazy volume, but it's just emotions, short squeeze, and then it ends up coming back and consolidates. And heck, it could head a lot higher, but at some point it needs to come back and consolidate. Next, what I want to look into is intraday parabolic and price action. Now, this is momentum that ends up happening midday. It not necessarily opens up and rips out of the gate, and that's where you take advantage of it, but rather it starts to grind, and it's slowly heading higher. It starts to go, and all of a sudden it just takes off out of nowhere. So what you're looking for is very similar, is a speed up relative to the prior price action. So anything that just starts taking off compared to how it was trading prior. And once again, you use the same idea, the whole numbers and $half marks. And many times, these stocks will cross one of those big whole numbers, rip, and then end up coming back, consolidating, and either pick higher or lower from there. But the point is anytime they start to break off of the trend, they'll end up coming back and consolidate and then go. And that's what we're looking to take advantage of. So let's take a look at DDD. This is a 3D printing company. And again, we're dealing with stocks that have been running quite a bit lately. Overextended charts that we went over. So you've got this nice big move, and it pulls back, and then it starts to go again. And at 49 and then 49.50, you're starting to think, all right, well, what's the next psychological target? Probably 50. So any parabolic move through that 50, we're interested in. And you can see how it starts to go up, and it kind of puts in a base here at 49, 49.50, and everybody's thinking, all right, 50. So it's just grinding up 47, 48, 49, and then boom, $3 through $50, and goes up another $2 instantly. So I went ahead and short into that, 51.90s, 51.92s, and then it pulled straight back, and I covered, and then I covered a little bit more up here. I gave it a little bit of a chance in case it came all the way back down here quickly, but it started to grind back up, so I went ahead and took the rest of the profits. And this is what I was kind of talking about earlier, is it's risky because a lot of people think, heck, it was just 49, it was just 47, it's got to go back down lower. And the truth is it doesn't. So anytime it starts to kind of grind, I go ahead and get out. Next up is MY, and it starts to trend. And then you see this nice little pop here midday, comes back, consolidates, and you can see like the ABCD pattern that we talked about, top here, and your risk would be off this 170 level, but starts to take off, and then it goes whoop, straight up. And you can see right through here, psychological number is probably going to be a 2, because it's 170, 180, speeds up 190s, rips through 2, sits back, consolidates. Now this is exactly what I was talking about before, is where it comes back and it starts to grind, and it's either going to pick a trend up or down after it consolidates. So you can see it rips up, pulls back, consolidates, and it looks like it's about to go again, and that ends up pulling down. But we don't know that, so that's why we take the instant profits when it does happen and go ahead and cover here. So that worked out great. Next is ABIO. Now you can see this ABCD type setup. Once again, you've got the morning move, and then it starts to grind. You can see the line right here, higher lows, and then it just pops out of nowhere. So you can see it went 230 to 3s, pulls back, 280s, 290s, 3 break, and goes almost up to $4. You can see how this action is parabolic relative to how it was trading before. So ideally the next number, what you're basing things off of, is 350 parabolic or 4 parabolic. So if you start in before 4, you need to give yourself room in case 4 pops and it goes to 417, 420, 450, whatever. So this is the danger of shorting parabolic because it very well could have gone to 420, 430. But intraday parabolic speeds up, go ahead, rips through 350, and I went ahead and short into this action because it literally went from 350 to 390, and I think it hit about 392 or 394, and I actually got 2 cents off the high shorting into that parabolic action because it was all the shorts that had been worked in here thinking it might pull back, plus the momentum traders. So the momentum traders are buying for the potential 354 break, and then all these shorts are getting all scared and end up getting squeezed. They start to cover, and I'm ready into the parabolic. Then it slams back down. I ended up covering right down here, 350s, 360s. It did keep on pulling, but when it goes 390 to 360, 350 in an instant, you take profits. Next is CBMX. Now, CBMX took a nice little move here. Again, starts to grind, and you can see that this is actually moving 2 to 3 to 4 to 5 to 6, all the way up to 9. So what happened is it was going all day, and it was kind of steady around this 5 to 6 level. Then it started to speed up, and it went 6 to 7, and then straight up to 9 over a couple candles. So I went ahead and short into that, and then it slammed right back down. So it went from about 950 to 8. I covered some, and then I started using the house's money, the profit that I just made, and started shorting smaller again, and it ended up fading back. Now this easily could have gone to 10, but I started to take the short, again, risky, because it started to speed up relative to the prior price action. All the way through here was just sort of grinding 10, 20, 30 cents, and slowly making a buck move, and right here it went up about 750, 850 to 950 plus before slamming right back down, and then again did the same exact thing. So once again, you're only taking advantage of emotion. You're not shorting this and thinking, hey, this has got to go back down to 4 right away. You're shorting this when it starts to break out on air, and by air I mean it starts to skip up 50, 60, 70, 80 cents at a time. You're taking advantage of that move, and when it sits back, when people say, oh crap, I got to take some profit, and they start hitting the market orders, you get that slam right back down to 8, and that's what you're taking advantage of. You're not staying around to see where it goes. Next is SRPT. Now we've played this one quite a bit, but you can see here this intraday move. You've got this week open, then it starts to head red to green, and it just takes off. There was no news driving this. It was just a positive article that somebody had put out, and the market responded. So you can see where it's got a solid trend going, but then all of a sudden it just starts to parabolic and went 29.50 all the way up through 31. So I went ahead and risked, because the 30 break is one of those psychological targets. So I went ahead and short into the parabolic through 30 and shorted near the top here, and then it instantly slammed back down. And I covered some here, went back up a little bit. I almost covered, and then it ended up fading off. And I went ahead and covered the rest. And as you can see, once again, it's got that big move, then it pulls back, and it consolidates. Here's Cure. Now Cure, keeping in mind that this thing has come up from less than 50 cents, I think it was about 30 or 40 cents, up to 60, consolidated, 80, and then straight up to 2. Now the next photo, I don't have the prices in there when I saved it. So keep in mind that when it starts to speed up, it was ripping towards 2. So you can see it's got this nice steady trend. If you remember, it started at 1, went to 120, and then any parabolic we're interested in. And again, note the volume. So it started at 1, 120, 130, started to consolidate, 135s, 140s, pulls back,
And you can see that it starts to hold the top here, right at this level. Top again, lower high, lower high. So originally I actually did get short, and I was early. So I shorted here, there's a lot of volume that came down, but then it started to grind up. So I went ahead and covered because I was wrong. Because that's what you need to be, wrong. If you're wrong, take it off. So it started to grind up, it wasn't doing what I thought, so I waited for a parabolic. And if you remember from the last slide, this was a move towards 2. I was waiting for it to break out, started a parabolic towards that 2. I shorted into the 195s, thinking that it might rip through 2, maybe an over and under. So I started in. I didn't get as much size as I would have liked because I was giving myself room in case 2 popped. But I shorted into that parabolic move, and then it faded off. And it basically squeezed everybody that was stubborn and didn't take their covers here like I did. Chapter 6 is a big intro into shorting, which is a little bit more risky than your normal set risk versus reward types of shorts. The parabolic price action is something that you really don't know what your risk is right offhand, and now you know that that's why we focus on half dollar marks and whole dollar marks, and scaling in and scaling out from there. The biggest thing that you've learned here now is a parabolic price action versus just another jump. There's so many people that will come to me and say, well, this stock's up, isn't it a short? But they fail to realize that stocks do go up. When dealing with these stocks that have really come off lows or even started to break out and are going up, 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 the biggest thing is understanding the difference between just that pop on the chart and what an overextended chart really looks like. And the biggest thing is now the consolidation that you're familiar with and what happens when it goes straight up, pulls back, consolidates, and how that shifts into a different type of trade. And last but not least, anticipating a short into parabolic price action. This is the intraday price action. Now you can take a look at the intraday chart and actually determine where and when the price is starting to speed up relative to the prior price action. And that's the biggest thing to really understand out of this chapter, because a lot of people look for a certain price. What price do you think it tops out at? The last top was X price. The stock can't go that much higher, and all these other false ideas. The difference between actually shorting into the parabolic before it sits back, then consolidates and fades off more, is the ability to actually size into a trade and risk with the house's money versus just going ahead and shorting with a set risk versus reward. In Chapter 7, we're going to start to talk about taking advantage of morning emotion and failed follow-through momentum. There's 2 trades here that are very similar. One is going to have that gap up and push in the morning with the follow-through excitement, the follow-through buyers that didn't get in the day before but feel like they have to be in as soon as they can. What we're aiming to do is benefit from this emotional push in the morning before it pulls back a little bit, consolidates, and then it picks a trend. We aren't shorting because we think that it's going to go down all day. We're not shorting because we think it's going to go up all day. We're shorting because we're just taking advantage of that morning push before it sits back, consolidates, and heads off from there. Failed follow-through momentum is very similar. You might have that morning push, but it doesn't really move much, and it starts to hit a wall. And when you compare it to the prior day's trend, it shows that it's topping out at the same area. And that is something that we can take advantage of with a set risk versus reward. Overextended fader, lower highs, and an overextended late day fader, very similar. These are all taking advantage with a set risk versus reward. The first one is the charts that we've gone over. We know that they're overextended, but they've consolidated. They've consolidated and started to head either higher or lower. It doesn't really matter. But the point is that they haven't really pulled back yet. So we're always looking for the potential short, the potential crack, because at some point there is a good chance that it's going to fill a gap or end up fading off before it starts to head higher again. So these are something that we're looking for: consolidation, sideways. It's got a base all day, and once it puts in lower highs, lower high, lower high, and it cracks that base that it's held all day, that's when you want to get short with a risk towards the top of the channel. Overextended late day fade and the momentum shift fader are dealing with these same types of charts, but being able to take a daily trade out of a stock. For example, if it's been extended for many months or many weeks and it's yet to really pull back, we know that each time it pops up big, there's a good chance that it ends up fading back. And we're just looking to be able to take advantage of that move, not necessarily marry the stock, but just know that there is a better chance that it's going to pull back after a big quick move, because there's a lot of people that are looking to take profits. And then last but not least, but maybe one of the most important, is what to watch out for. So many times we're too involved in nailing the trade that we don't even see another move setting up. And what you'll see is when stocks start to pull back and they start to consolidate again, if you start to see that ABCD type pattern that we've covered in prior chapters setting up, you need to reconsider your short, you need to potentially take profits, or you need to cut off your loss.
The next short that I want to talk about is taking advantage of morning emotion. Now, typically this is just a quick trade right out of the open where it's got a lot of emotion that follows through from the next day. People see that it closed near the highs and they think, hey, it's probably going to go up a lot higher. Might as well buy in. And a lot of times you've got just that, a steady push right out of the gate. And then as soon as it hits the prior resistance, which in most cases is the day before's resistance, it ends up pulling right back. And then it ends up consolidating, and it either heads higher and lower from there. But we don't care about that. What I want to take advantage of is that morning push. As soon as it hits a wall, join the short side, and then cover as soon as it starts to consolidate. A lot of times these barely hold into close. So let's just say they've had a nice run the last couple days, starts to go up into the close, pulls back, goes up again, lower high, pulls back, but it's just barely hanging on, and then boom, market closes. Thank God it held on. So then what you want to do the next morning is use that as a reference. Whatever those highs were, you want to use as a reference, and you can judge your short accordingly. So take a look here, this AAMRQ, where I was going up into the close this prior day after barely hanging on. It had gapped up, came, it ran to 140, and then pulled back. And then this day, it opens up and it runs out of the gate and it ends up pulling back. Now again, it doesn't mean that it's not going to go higher. It means that there's emotion to take advantage of out of the gate. As you can see, it opens up. Keep in mind the day before it had really washed out, and then it came back and stabilized by close. And then this is just a little bit follow through momentum. It comes up, and not necessarily that you would short into here, but it comes back, then it has a lower high. Now you have a set risk versus reward off these 160s, 155s, and you can short this 140 for the fade. And you can see exactly that, where it cracks this lower support. You've got this big morning move, comes down to support, comes back, lower high, support, cracks, and it fades. And again, just to bring back the other chapters, you can see this gearing and consolidation here, ABCD type pattern, where it starts to grind up, grind up, grind up, and it breaks, and then it has a nice little push into the close. And again, this isn't the short side. I'm just trying to bring everything together again so that it stays fresh in your mind. Now you're going to see a lot more of these. Failed follow-through momentum. Same idea, morning move, but you're looking for the lower high. Very similar to what we just saw on AAMRQ. It's a bullish chart, but it sort of had a hiccup out of the gate. It went up, pulled back, tried to get going again, and it just couldn't hang on. So once you have that set risk first reward and it consolidates and it fails to go back up, that's when you go ahead and take the short. A lot of times you'll see this in different types of sympathy or sector plays where the solars might be hot, and all of a sudden that hot solar that lighted up the entire industry is no longer hot. So you want to look for all those other sympathy ones that you can find this lower high and then short accordingly. Let's take a look at DANG. Obviously, it's a nice bullish chart, and there's probably going to be some follow-through momentum where it goes up, but as soon as it hits a top, pulls back, and then it can't re-break that, now you have a set risk first reward. And that's what we're looking to take advantage of. So you can see this chart here, 662 close, opens up, nice move out of the gate, then it comes back down, consolidates, goes up, lower high. Now, if this lower high sticks and it starts to fade off, you can risk and you have that set risk first reward off the high days. You can see here, lower high here with the former base here, and DANG failed follow through momentum, eyeing for a short if it can't hold the trend. So if it can't hold this trend line, I want to short it. And then once it does break, you want to watch all pops for shorts. Because maybe you don't always get it right here, but each pop up is a good short because you have that good risk versus reward where you might be risking maybe 10 cents or 15 cents for the potential of a 30, 50, or $1 drop. And actually the very next day, you can see the same exact thing again, but it looks a little bit differently. You've got that morning move, pulls back, then it starts to go back up again, and it fails to hold, number one, red to green, but it also starts to fade off. And now you've got a risk on 660s at 650, 645, where you can short, you're risking 15 cents or so for the potential of a pullback. And now remember what the chart looked like. You've got a very big move off this 4 to 5 to 6 and almost $7. So there's a good chance that it is going to pull back because it is overextended. And that's exactly what we got here. And you can see again where it goes up, lower high, and again the base here provides another opportunity. Let's just say you don't get this one where it has a lower high. So now you've got this base, comes back up, lower high, base, and it snaps. Now you want to short all pops as long as that base acts as the top. And as you can see it does, and it slowly fades up. It's all about having proper risk first reward here. Anytime that you can have a set risk first reward where your reward is at least 2, but I usually look for 3 times the risk, that's a good trade in my book. Let's take a look at NIHD, and you can see, once again, failed follow through momentum where it's got that nice move into the close, trending here, 795 breaks 8, continues on 830, 840, 850, but you can see that from 2 to 4 p.m., the last 2 hours of close, it kind of goes up to 855, has a little trouble, then kind of tops out at 850, then fades off, then just barely hangs on, and it closes right around 850. Well, guess what? The next morning, that 850 I'm interested in. And if it can't break that 850 and hold over it, then I'm going to risk on the prior day's high. And you can see where it had that top here, and it comes back over that 850, and it can't break it, it can't hold on. So now, you've got all these people that pretty much bought in thinking, had a nice day, it's probably going to have continuation, maybe it goes to 9, but it's having trouble with that 850 and it can't hold it. So at some point, all those momentum traders are going to turn into sellers. And the goal here is to be able to take advantage of that. And you can see it washes out here. So technically, you may not have been prepared for that move, but it comes back, tops out again, over and under 850, and now you can short all you want as long as your risk is based on over and under of 850 and a set risk on 855. You can see once again the nice pullback and washout towards 790s. Here's another one, TSL. It's a solar stock. Now you've got 2 big days. Now you've got the idea that everybody's probably buying for the 6 break. Well, what if it doesn't break 6? Well, you can see out of the open, it doesn't have any follow-through momentum. It just kind of opens up and it's kind of, nobody really cares. So then it retests towards red to green. You can see it kind of chops around and then starts to go back up. Fails at 580s. Now you can short based on either the high of days, or you can give yourself room until about 6. You've got that nice washout. Ends up coming on and putting the short sell restriction on, which means if it drops 10%, you can't short the bid, which I will be going over later. But end up rebounding real fast right off of that. And again, not necessarily that you would short into this move, but what are you looking for? You're looking for failed follow-through momentum. So let's just say this is the big move, pulls back, lower high, pulls back, lower high, and you can see where it's forming the support the whole time. Well, when it cracks this, now you have these prior highs as the resistance, and that becomes your risk. This is UNIS. You can see obviously 2 10 million share days, very big move, 180s to 3s, almost up to 4. Then the next day it opens up, but it doesn't really do much. So how do you trade it? Comes up, pulls back, comes up again, tops out again, doesn't really have much follow-through momentum, starts to fade off, and now you can anticipate a green to red, across from green on the day to red on the day, failed momentum, it's not going to 4, and if it is, it's okay, you have a set risk versus reward, you're risking about a dime, cracks, and you have a nice washout. SPWR, this is another example, same idea. Doesn't really do much out of the gate. Pre-market here, pulls back a little bit, comes up, 930 opens up, tops at the same price. Everybody's thinking maybe a 16 push, but guess what? It doesn't. It tops. So now, how do you trade it? Now, as soon as it pulls back, and then it retests back up, 1580s becomes the top, you can short at any time and you're risking off that whole number or the high of days. You can see right here the top that it puts in, using the pre-market as a guide, and then it fades right off. And again, remember, you're focused on charts that have been in play, charts that are overextended, and charts that have barely held on the day before. Now this next one, ONVO, it probably shows you exactly the trade that I'm looking for, 3 times at least, and it's probably the most clearly depicted. You can see here this nice big move here, and it gaps up. It doesn't really have much follow through and it washes out. Same thing here after the big day. It has a little bit of follow through but puts in a couple tops and then fades off. Same thing here, big days, puts in a little bit of top, failed follow through momentum, fades off. So now let's look at what it looks like intraday. And if you remember, I said a stock that barely hangs on during the day. So this is the day before the short that we're going to be talking about here on ONVO. Now it's going up, very big move, 310, 320, 350, 380, up to $4. Pulls back, it's barely hanging on, lower high, barely hanging on, it's sort of grinding, and it closes just about around 390 or so. Next morning, opens up, gaps down a little bit at first, retests towards that 390. Now remember, you're using the prior day's highs as a guide. So you've got these two right here, and you've got this right here on about 395. So it pops out of the gate. If it's not lifting the offer, if it's not getting through 4, then the sellers keep coming up to the plate. And again, the sellers are on the right side of level 2. So this one opened up, started to get a nice little push, and then all of a sudden a bunch of sellers came on the offer, and more sellers, and then the bid started to get hit. So I went ahead and went short. Failed follow through momentum. You see the top here using the prior day's highs, and that's where I went short. Just to show you a one-day chart, you can see again here where it opens up, pulls back a little bit, retests, and it can't hang on to that green for the day. And again, your risk versus reward, you're risking on the 390, 395 level from the prior day's resistance. Now, it's not always that easy. So you've got this one here, failed follow through momentum on FOLD, and you can see this nice big move here, and it pulls back, and it hangs on again, fails, pulls back, but you can see it's kind of gravitating towards 4, and that's why I had the interest in this stock, because it was a dead cat bouncer off this 250 level, meaning no real news or anything, but it was just a short cover and momentum trade, bounce players and everything all combined, which created a nice little momentum trade. Now, this one went up in the morning, pulled back, and you've got these lower highs, so you can go ahead and short at this level. That's great. But then it started to hold, and you had a higher low, and started to grind back up. So that's what you need to take note of when you're trading these. They're not always going to go back down. So you've got this set risk versus reward. You can set it off 420 level, 415 level, because you've got the lower highs, and you might want to get short right here, and it fades off. But guess what? It starts to hold, grinding, and anytime you see this ABCD type pattern, you need to take it into consideration and go ahead and either cut it off or take your profits. Now the following day, same idea. Again, remember this is a semi-overextended chart, but the next day, it finally did that, and that's where it got short, faded, came back up, lower highs, and you could risk based on this 410, 420 level, and it had that nice fade all day. Now again, you can see this gearing action. I would have been out by this 395 level, so I wouldn't have held it by the end of the day, just because you can see the same ABCD type pattern setting up here. We've got this top, and it starts to grind. But the point is it's not always going to go straight down. And when it doesn't, you need to be able to recognize the pattern. So you can see here, it did, failed follow through momentum, lower highs, go ahead and short, risk on these levels. But if it doesn't, be aware and know what to do. Now once again, it's not always going to be the first couple of minutes. Yes, you could have shorted into this little pop and made a nice little score from 940 to 890s if you're prepared for it out of the gate, where the day before it was topped out at about 950, it opened up a little bit, couldn't get through 940s, and then you go ahead and get short and get a nice little washout, and that's something that you could have been prepared for. But the other option here, which I want to show you, is the lower highs over here, and what you're looking for is that it comes out of the gate, it washes out, comes back, and it starts to fade off, and you can see where this support is, and when it cracks, that's when you want to get short on the 910s. So again, all of this is going to kind of come together, especially with the late day fades, and you can see that all these charts and setups and everything kind of interrelate, but it's just at different times of the day, and when we care about them, and why we care about them. So again, you've got this nice morning little push, doesn't have enough to get through the 950s, you can go ahead and get short over and under 950 as your risk, and it washes out. Otherwise, fail follow through momentum, comes back up. It's a big chart. If you remember, we went over this stock and it had come up from the 5s to 6, 7, 8, 9 without really any pullback. And then it had a lower high, and you can go ahead and risk accordingly as soon as it breaks through this consolidation, and you've got your risk set on 920s, and you'd be able to keep it all day without hitting any stop. So to see that visually, you can see here, lower highs, lower highs, lower highs, snaps right here, and then that's your risk. The next thing I'm going to cover is one of my most favorite trades. It's the overextended fader, the lower highs, and also the late day fades. So these are stocks that have been in play over recent days, and it's when the momentum starts to shift. And what I mean by momentum shifting is instead of going up and always being on your toes where it's about to break out again, and then it pulls back, and then it looks like it's about to break out again, and you're nervous or you have emotions involved if you're already short. Instead of that, it's on the backside. It's when it starts to have the lower highs, and then each pop ends up becoming an opportunity to short because it's put in a top a bunch of times. So you know, okay, if it does pop, I'm going to risk off this amount. So each pop, like I said, becomes an opportunity with a set risk. So you look at pops as good. Most of the time it's an overextended chart, but the point with these are it hasn't really consolidated yet. It's still on its initial run, it's straight up. And it goes straight up, straight up, straight up, and it's still hanging on. And it's not the one that goes parabolic like we covered last time, but just kind of goes up and then it hovers. It goes up, hovers, goes up, hovers. And that top that it's putting in is what you want to be able to set your risk off of. And the only time that you're interested in it is late day fades. Once it's got this also bottom where it's got a base and then it retests lower high, base, retest lower high, base, retest lower high. When it snaps that base, that's the trade that you're looking for. Most of the time it might have a big morning range followed by a flat line, and then as soon as it cracks that support, that's it. That's the one you want, and I'll show you exactly how to determine risk. And once you see all these images and all these charts that I have, it's going to make a lot more sense. Late day fader, lower highs, it allows you to define a risk based off the prior high. So rather than go into something like a parabolic short, like I said at the beginning, a parabolic short is one of the most riskiest because you don't really have a game plan. You know you want to get short at some point. You know that it could keep going, but you don't have a defined risk versus reward. So that's exactly what this is it's a defined risk versus reward. You want to wait for the momentum to shift. Once it snaps under that support and support becomes the new resistance, that's where you're interested in. And once that potential reward is 2 or 3 times your risk, that's when I personally like to anticipate the trade. So take a look at CIMT. Now this is, again, like I had said, it hasn't really consolidated yet. Sure, it consolidated around the 720, 750 level, but now it's on a whole nother bull run in 7, 8, 9, 10, 11. So what I'm interested in is not necessarily a parabolic, not necessarily any pop, but once it starts to put in lower highs, and I can see a base forming, if it cracks that base, that's when I'm interested. So you can see right here, it's got that nice morning move, pulls back, morning move, pulls back, and now you've got lower high, but you've got this base forming at 1150. So the idea is later in the day, if it cracks at 850 and it can't get back over it, so it cracks here, retests, and now it's a top, and it fades, and washes out. Again, very overextended chart. That's how you're predicting that it's going to be able to pull back as fast as it does. And again, later in the day, because it gets rid of all the momentum and you can see where the momentum is shifting. Right here, it's kind of choppy and starts to keep going again, and you can see each pop is pretty big. It still has shorts on their toes, it still has momentum players chasing, but then it starts to pull back. And instead of going, higher high, pop again. Now it's pop, pulls back a little bit. Pop, lower high, pulls back a little bit. Pop, lower high. Look for that base, and you can see right here at 1150, you can see this trend, lower high. As soon as it looks to snap, go ahead and anticipate the short. Now, your risk is based off this level here, this 1175 level. If you wanted to go larger, you want to have a tighter stop. If you want to have a wider stop, obviously you pay a little bit smaller, and I would base my risk off 12. Now take a look at NBG. Now this thing has just been on a tear from 60 cents all the way up 80, 90, $1.60, $2, $2.40. So it's on our radar. There's a gap here, a gap here, gap here, gap here. It hasn't pulled back. Maybe pulled back one day here, pulled back here. But there hasn't been any consolidation really since it crossed $1. So what do we look for? Same exact thing as CIMT. You've got that morning move, not necessarily going to do anything. This could go to 250. You don't know. It could go to 3. But then it pulls back. And you can either short here. Most of the time, I probably wouldn't have. But you could either short here, and it comes back. But what I'm looking for is it to base. I'm looking for a base to start and lower highs. So, boom, washes out, goes back up, lower high. Base. And you can see it starts to have a lower right here, and obviously the move is to anticipate the 2 break. Now you have a set risk versus reward on 210 versus here, where it could just kind of float up and it could go to 250, 270, you don't really know. But on this, the momentum is shifted, lower high, lower lows, 2 wash out, and then it snaps. And again, how and why do we know that it's going to have a big washout? Well, look at the chart. It's yet to consolidate. So the first time people have a reason to take profits, it's going to be a big washout. You can see here with arrows to help you out a little bit, the risk right here. So you've got that morning move, washes out, rebounds. That's your set risk. Here's your base, snaps. Typically, I would probably cover at least 1/2 right here, or probably all, because a 205 snap to 180 is a pretty big gain. But again, if you weren't able to get short at this point, this provides another opportunity where it rebounds up, down, lower high, starts to get tight, and if it looks to crack that again, it's going to wash out. The last thing to note here is just the volume, and you can see when it starts to break out, when it starts to bottom, you can see that big volume in right here. So it's good to take note of that, only because it's usually followed by a trend change or at least consolidation. And you can see here, there was a little bit of consolidation here, and then obviously it didn't hold on, but again, you had massive volume here, which is panic selling, and then new buyers, and then it ended up rebounding. But typically for me, I follow volume, and I usually react when there is this volume and when there is this action around these levels. Jazo is another big mover. This was pre-market action, pulled back, and then ended up fading off. But
what I want you to see here is, you've got the lower highs, and you can see how it's forming a base at 980s, 980s, 980s. And this is actually a short that we took into the close because it ended up having a lower high. The risk is based off this former top. Again, I look for areas where it starts to make a top. You can see another top here is forming, but right here, base at 980, base at 980. Right now it's stuck in the channel, but as soon as it puts in that lower high and it snaps, you're going to get that nice little washout. Now this is a morning trade that I took, but it really shows you exactly what I'm looking for, so I threw it in there. But this was during the solar run. TSL was extremely hot. It started running with them as well, and it gapped up and it ran towards 850s. So this is the morning move, and then this is exactly what I look for late day. Pulls back, it started to put in a base at that 8, pulls back, rebounds, puts in a top, pulls back, lower high, pulls back, lower high, and as soon as it snaps, that's when I want to go because I can risk right here on any size that I'm comfortable with. If it's 1,000 shares, I'm risking $200. If it's 5,000, I'm risking 1,000. But there's a good chance. Remember, we're talking about $8 here, and it had just ran up. It's only had a couple of red days, but it's been on a tear lately. There's a good chance that it's going to pull back, and that's exactly what happened. We got short right around 8, 810, 805s, and it faded off. It had a nice little washout to the 690s. SBGI was another big mover. Now you can see it kind of puts in a top here and it's gearing, so there's a good chance that it's going to go higher, which it did. But what I want to focus on is where does it form that base and what can we look for late day. So you can see this 2675 level base comes down, base, comes down, base, 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 base. The next thing you want to look for is lower high. So it comes back, lower high, lower high, lower high. Each bounce is having a lower high. So then we can anticipate that short with a risk based on 27 level, anticipating the late day fade back. And again, it doesn't have to go down, but typically people take profits into close. Here's another one, BYD, and as you normally would see, it's a nice little overextended chart, but the thing that you need to take note of here is just like I was talking about earlier in these wicks, how they start to get bought up. And when a big move ends up getting bought up each dip, it turns into bullish consolidation, and what that means is it's most likely going to go higher. And as you can see, once it busts through this 12 top that it had been consolidating up towards, it broke out. And then again, you can see all this consolidation, these wicks, and it's putting in a top at 13. Once it breaks that, it broke out. So this turns into something that is not really a parabolic breakout or a parabolic that we want to short, but rather we want to wait for it to break down. Otherwise, you never know if you're going to be a day, 2 days, 5 days, or a couple weeks early. So let's take a look at the 4-day chart here. And as you can see, you've actually got a little topping action at 1450, and it pulls back. Nothing really that you're going to do. Kind of grinds, goes back up, retests. It's got a lower high, fades off, double tops, fades off, but you can see that it's starting to put in a base here at this 1425 level. Then again, lower high, and it finally starts to crack that base that it's put in. And that's what you want to focus on. You want to focus on when the momentum is shifting, when it's no longer just kind of grinding up higher lows, and it looks like it's going to continue to go on to 15 or however high it may go. Just like you saw right here where it started to consolidate and it kept on going, consolidate, kept on going. So what we're doing is we're waiting for it to finally stop that consolidation and grinding up, but actually put in lower highs, and wherever that base is, when it snaps, that's when we want to get short. And now we have a set risk first reward, which is towards this level, or even the previous double top right here, you can see. And as soon as it snaps that, you want to get short, and as you can see, it finally had the momentum shift off, and it actually lasted for nearly 3 days on the pullback, and you can see on the daily chart, this is the day that it kind of topped off, and the last couple of days it started putting in tops, and the wicks ended up closing off high, retested again, and it failed, and then it faded, and the next couple of days, fade. So again, let's look at another chart. You've got a nice big move. Typically it might be an overextended chart, but instead it starts to consolidate at a higher level. So it's breaking out here, pulls back to 750. It's normal for stocks to pull back. We might have taken this parabolic short this day where it gapped up and sat back,
But the point that you want to see here is that it's starting to consolidate and it's holding higher lows and it's grinding. But then it starts to put in lower lows, and you can see each wick, it tests the 8. So now we've got a short-term top at 8. So any good push towards 8, whenever it puts in a lower high, we know we can risk towards 8 because there's a good chance it's going to top out there. And if it doesn't, we're going to stop out. So you can see this slow action, parabolic, consolidate, and then it puts in that short-term top that I was just talking about. Now here it is intraday, and it's moving towards that magical 8 number, and it starts to fade off. So here, goes up, pulls back, goes up, lower high, and it's pulling back to this consolidation level, and then it snaps. So you can get short anywhere around here, and you're risking towards that 8. And that's the point with these types of charts, is you have a set risk versus reward. Anytime you can risk a dime, 15 cents for the potential big pullback on a big chart, it's worth the risk. So you can see how it's grinding up, puts in that flat that I was talking about, and then snaps. Now this is a more recent example. This is EVC, and as you can see, I mean, it has pulled back and consolidated, went back up, consolidated, but it hasn't really had any big pullback. It's been straight up since 2. Now it's starting to put in these tops at 5, and each time it keeps on retesting, it's fading off. So what I've noticed is each morning, the morning moves towards 5. When it meets that resistance, it ends up fading off, and it's something that we can take advantage of. So, late day fader. Let it have that morning momentum, and then instead of finding where it has higher lows and it keeps on grinding up, and you don't really have a set risk versus reward, let it tell you. You can see it bases here, and it starts to form a short-term top here, bases again, and then it finally cracks. And as you can see, with the lines on the chart, you've got the top here, and as soon as it cracks this level, you want to get short, and your risk is right on this top of the line here. And then you've got that nice afternoon fade, and it finally pulls back. Because once again, although the chart had gone up a lot and consolidated along the way, it didn't have a big pullback day to date. So you can see here again, this is the same idea, only it's on multiple days. You've got this big push towards the 475 level. Probably a lot of people thinking 5's coming, but you can see where it starts to top out. And then here at 4, you can see where it starts to top out. And then 350, you can see where it starts to top out. So the point is that you start to see where the resistance ends up. And when it retests that and it fades off of it, guess what? You can get short and risk to that level, and it's a good risk versus reward trade. So you can see here intraday, this is actually going back up. This is April 18th, and it's going back up towards that 4 level. And it ends up failing and fading off. So it's going up, then it fades. You can see this top here. Then you can see it getting into this channel here for the late day break. And the whole idea is this is the back side where the momentum shifts. So you can see the top, lower highs, and then it gets in this channel and it snaps. And then any accelerated move downward is the panic, and that's where you want to cover into. And a lot of times you're going to see the volume, and that's exactly what happened here. And it's going to work right into a panic, right where the sellers meet the buyers. And at some point, it's probably going to bounce, and that's exactly what happened here with the big volume. And obviously, there were more buyers than sellers, and it started to rebound off the lows. Same idea again. This is off that 5 level when we started to see it topping out in the 470s a few times, but you actually see it test here, fade off, retest, fade off. Well, guess what? If it's going to start to crack towards red, now you have a good set risk versus reward to this double top. You can short using a risk of 465 or so and anticipate that red to green move. In this case, it was actually a negative tweet about it. We went ahead and went short, and I've sized in based off this double top here. So right away I knew, okay, my risk is 10, 15 cents. I'm going to size in 5,000 shares. I'm going to risk $600, potentially make, if it really cracks, 50 cents or $1 per share. And once again, when it starts to go into panic mode, you want to go ahead and take profits along the way, at least 1/2. It doesn't mean it's going to go right back up, but a lot of times it's just reduced headache. If you go ahead and take something off into the panic, even if it continues to go to 350, to whatever, you leave some on the table. But I always make it a habit of covering into the move that I anticipated. Got 2 more different momentum shift faders examples. And you can see here, this has got a nice big morning move, pulls back, big morning move, pulls back. and it starts to put in lower high here, lower high here, and it starts to put in this base at 210, as you can see, where it's kind of hovering and it's a magnet around 210. Well, when that snaps, you can get short and risk off this 220 level. Trading is all about having proper risk versus reward. If you can short anywhere around here, anticipating that 2 break, with a risk on 210 or 220s, that's perfect. Same thing here, GMCR. The key here, it was running up over the past few weeks, few days, and it started to pull back this day, put in a top, morning strength, started to fade, 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 but you can see here where 24 starts to become a top. 24, 24, 24, pulls back, retests it, fails it going above 24. This is the first time when it retests it that it hasn't broken it, and then you can go ahead and anticipate the fade. So it all seems easy. You wait for lower highs, you wait for a top, and you wait for some type of bottom to break. Well, what happens if it does break, and then it consolidates and it starts to get going? This is where your rules come in. This is where you need to watch out and realize that, hey, stocks do go up too, and if it does start to trend change and starts to go against you, you need to go ahead and take it off. So what I'm going to focus on the next couple is what the grinding looks like, where instead of having lower highs, when you start to have this higher low and it starts to come back up, at what point where you should stop out. And instead of adding onto your short and adding onto your short and then all of a sudden being in 2, 3, 4 times the size and it goes against you, now you've got 4 times the loss and you're unprepared for it, what you need to be able to see and how you need to be able to adapt is what I want to cover here. So, take a look at RCON. You've got this big morning move, comes up, then you can start to see it's putting in a top here, and lower high. Comes back up here, lower high. But you see, it's got a top here at 220. So you might have anticipated a fade here, risk on 220, or right here, it tops again, and it looks like it's going to have a nice little 8-day fade. Why not anticipate the 2 break? Another little 220 top here. Why not anticipate the 1 p.m. the late day fade? Here it goes. Faded. Oh, wait a minute. Rebounds right back up. 220, higher low, 220, higher low, breaks. Now you need to make a decision. Are you going to fight it and you're currently wrong on the position, or are you going to go ahead and take it off because the trade was for the breakdown, it's not happening, and now it's ending up reversing and breaking that prior top. As you can see, the 220, 225 level, double bottom, breaks out, and there it goes. If you fight this, you're going to end up getting squeezed into the close, and as you can see, the late day moves can be pretty powerful right to 288. So now you've got GMCR. Now this is a really big run, and it had a big morning move, pulled back. This is right at open, nice parabolic. And you can see that it's got some support here, that it put in a double bottom and it started to rip. But now it goes up, has another higher high, pulls back, lower high, pulls back, and you can see the support here at 36. And you might want to anticipate the 36 crack and washout because it is up quite a bit. This is a big gapper. It's up about $5, $6 on the day. You think, well, it might wash out a little bit. Nope, ends up pulling back. Still about even, doesn't really matter. Grinds off, holds a higher low, and now you can see it starts to have a little higher low, higher low, higher low, and it's grinding. You need to watch out for that. You can't fight this position because as you can see, it can continue to squeeze on. Kirk's, this is a great example of a stock that actually broke out and it ended up having the lower highs, and you would have made some money. However, if you get stubborn with a trade like this, look at the next time that Kirk's breaks out. Breaks out, pulls back, so you get your lower high, snaps that prior support right here, fades off even lower. You're making money, you're happy, but guess what? Starts to grind up. And if you don't see this big picture here, you're going to end up getting smoked because there's a good chance it starts to go back up a little bit, you add a little bit, and then all of a sudden it breaks through that prior resistance and it squeezes the heck out of you all the way up towards the 875s. And then instead of making some type of normal decision where you'd stop out, you make an emotional decision, and you get squeezed out right here, and then it ends up fading back off. Now let's take a wild example here. SRPT. Once again, why you need to just pay attention to your rules, have a money stop loss. You do go with a certain plan, but sometimes obviously it doesn't always work out exactly the plan. It doesn't always work out that you're able to get out at the exact price that you want. So you need to have that max loss, your max pain. The times that you get stuck, there's got to be that number that is not going to take you out of that game. Something, for example, where you might have found this nice little breakout, goes up, pulls back, and it looks like it's going to fade, snaps, and you're thinking, well, you know what, maybe I'll take some short, because, I mean, think about it. It was just $15, and now it's 30, so it probably would pull back to 28, no? So you do that, and then it starts to grind, and you've got 1,000 shares, just let's say, for example. Well, all of a sudden you say, oh, wow, it just popped up to 31. Maybe I'll add a little bit. Okay, now you're down $1,500. And guess what? Straight up to 45. Now all of a sudden you're down 10, 15 grand, and you're thinking, crap, I should have stuck to my original plan. And this is what can happen when you start fighting against positions, when you don't take into account the grinding action on a big chart that starts to rebound, whatever it may be. The key here, the point here, is you need to have a hard money stop. And when it starts to break those prior highs, you need to either ask yourself, A, am I in full size and do I need to get out? Or B, what's my game plan and what's my actual stop? How much money am I willing to risk to be right, or should I go ahead and take it off? And most of the time, it's better just to go ahead and take it off, because the fact is you were wrong. It's not doing exactly what you were thinking. And here's another one. This is actually another more recent example, which I actually shorted myself. And we had that nice over and under of 3. Keep in mind, this thing's been grinding up all day. It actually came from even lower, under 2. And it was going up, and then it finally sped up. You can see right here from 280s to over 3. So I went ahead and short into the 3, anticipating the over and under, and nailed it. You know, it had a nice little pullback, faded again, and it went down to 280s or so. But what you can see here is it starts to kind of grind back. You've got a 3 top right here, and you've got higher low, and it starts to grind back up again. If you can't recognize this trend, you're going to get squeezed out to more highs. So that's the type of parabolic charts that I look for short setups. That's the type of late day fades that I look for short setups. But when it starts to consolidate at higher levels, when it starts to grind and it has that short-term top, if it looks like it's about to break out, you need to cut your losses, or you need to take your gain. If you don't, you're going to end up in a bad position.
Now you've learned how to profit off emotional buyers chasing in the morning move before it consolidates and ends up picking a trend. You've learned how retopping at a prior day's resistance and then fading off can actually be extremely profitable and give you that set risk versus reward. And you've learned when you need to actually adapt and when to change your view from a parabolic to a lower high type setup and be able to risk accordingly to the higher days and know when the momentum is shifting. And last but not least, most importantly, you learn what to watch out for. And when something starts to set up for a long trade again, you need to reconsider your short and potentially take profits or your loss at that given time before it starts to slowly grind against you and you're in a hole that was easily avoidable.